Welcome back to another Founders Insights. Today, we're talking 1031 exchanges, and we're not talking tick structures and exchanging from a personal investment into a sponsored investment. We're talking about 1031 exchanging from a syndication to a syndication. And here, along with many other reasons, is where 1031 exchanges get complicated, particularly when you're talking about syndications, because a lot of people come to understand that a syndication is a partnership investment and you don't actually own real estate. So you actually can't 1031 exchange a syndication investment. However, the entire partnership itself can 1031 exchange into a new investment. So you have to understand that when you're talking about a 1031 exchange at the deal level, you're talking about the entire partnership exchanging into a new deal, not the individual investor 1031 exchanging themselves. However, the individual investors making up that syndication can go with the partnership and move forward with the exchange, or the existing investor or the individual investor in the existing partnership can elect to be bought out of that partnership and not go along with the 1031 exchange. So this is kind of the best of both worlds because you have the flexibility of, at the individual level, to opt for the exchange or not opt for the exchange. Yet you don't have to deal with the individual headaches associated with a 1031 exchange. At the end of the day, we all know that to pull off a 1031 exchange, there's a lot of work involved. There's legal fees. You need an intermediary. But the benefit of doing it inside of a partnership is you, the individual investor, don't have to do that stuff. So you don't need an intermediary because at the partnership level, we will handle the deal-to-deal 1031 exchange. We'll handle working with the intermediary, with our legal team, working with the lender. So in many 1031 exchanges, actually the individual doing the exchange has to actually sign on the debt or at least be underwritten by the lender. And that's not very pleasant and that's undesirable. So what's great about the partnership exchange is that as the individual investor inside of that partnership, you don't have to sign on any loan. You don't have to have any liability or even be underwritten by the lender. So it really is a huge home run, and it helps facilitate what 1031 exchanges are there in the first place to do, which is be an amazing long-term generator of wealth. Because if you can invest into a deal, have it go successfully, and then exchange it into the next deal, you don't have tax drag associated with going from transaction to transaction because the 1031 exchange allows you to defer capital gains taxes upon sale so long as you roll over the gain into the next investment. And this allows you to just continue to exchange and compound your wealth at a faster post-tax rate. You can dig into our coming soon 1031 exchange guide to see just how powerful this long-term wealth compounding tool really can be. But speaking of the kind of some of the more nuances of an exchange, another common question that we receive is the debt allocation associated with a 1031 exchange. When we work with some of our big investors that come to us with, let's say, a rental property that they own or a commercial building that they own, and they want to sell it and 1031 exchange into one of our upcoming investments, we need to be mindful of their current debt to equity ratio versus the debt to equity ratio of the deal that we're acquiring. Because one of the rules for a 1031 exchange is you have to replace the entire value of the deal, not just the equity. For example, if you own, let's say, a commercial building with $1 million of equity and $1 million of debt, you can't just exchange that $1 million of equity and buy a rental property for $1 million cash because you didn't exchange a minimum of the previous value, right? The previous total value there totals up to $2 million. So you have to invest into the up leg of a deal that is at least $2 million in value. Now, where it gets more complicated is you don't necessarily have to replace the debt and the equity one-to-one. The total needs to add up, but you can have a different mix. You can exchange the $1 million and you can just simply replace it with $1 million of debt on the new deal and you buy a $2 million property. Or you could buy a $3 million property and put $2 million of debt and transfer over your $1 million of equity. That's all fair game. Also, less thought about, but the same is true. You can actually take your exchange where it's a total value of $2 million and $1 million of equity, and you could buy, let's say, a $2 million exchange property, but you can do $1.5 million of equity and $500,000 of debt. You're still replacing the total value of $2 million, but now you are just changing the debt to equity mix for that total to still add up. So what you'd have to do there is actually bring in an extra $500K of equity out of pocket in order to still hit that minimum. But most people don't do that, right? Because most people, when they sell something, they've created value. So their debt is now at a lower LTV than when they went in, right? You might have bought the property with a 75% LTV, and then you created value. So the value went up, but your debt stayed the same. So now you're at perhaps 50% LTV, and you're ready to exchange into the next project. And so you exchange into a new deal with a debt to equity mix of, let's say, 75% LTV, right? You're back to where you started, but you're buying a more expensive deal. And that's kind of how you recycle and trade up, and you grow your pie over a long term. When it comes to all of the complications associated with the debt to equity mix, this is not a problem when you participate in a deal level exchange. So if you're one of our investors and we're selling a deal and we're 1031 exchanging into the new opportunity, you don't have to worry about the allocation of debt to your equity or anything like that. We're going to ensure that at the partnership level, the partnership is exchanging and we're handling the debt in the new deal appropriately and according to the minimum requirements to facilitate the exchange associated with our down leg. We're currently in the process of exchanging a deal right now at the deal level, so our investors have the opportunity to roll with us into a new fantastic opportunity. This is a huge win-win because our investors get to receive the benefits of a sale right now and make some money, but they don't have to recognize the gain because of the 1031 exchange feature, allowing them to defer the gain, and they can take that gain and put it into a great new investment opportunity because right now is a super exciting time to be investing into multifamily real estate. So if you're interested in learning more about partnering with us on an upcoming deal and having the chance to participate in a later exchange, please reach out to us.